Hey everyone, my name is Jack. Welcome back to the channel. I cover a variety of topics as they relate to investing and personal finance. So if you like that sort of content, be sure to have a look around the channel. And if you like what you see, be sure to subscribe. But this is the 15th of the month, which means this marks another episode of my M1 Finance portfolio series where I'm attempting to build a $100,000 portfolio in this platform, M1 Finance. I track my progress every month and I show you any changes in the portfolio. You can actually copy and paste this portfolio into your own account if you have an M1 Finance account. It's free to set up an account. I have an affiliate link in the description to do that. It would help the channel out a lot if you end up doing that. But even if you don't, you can set up the account and check out my actual portfolio holdings in detail and can actually copy it to your own if you want to do that. It's something that M1 Finance offers that's pretty cool. I'm not a financial advisor, of course, and just some guy on YouTube after all. But if you want to use it as inspiration for something, or maybe to get some ideas for your own investment research, then go ahead and knock yourself out. But you'll find that in this series, I'm not a typical YouTube investor. I'm not someone who's going to go and pour tons of money into high-flying tech stocks, and that's my whole portfolio. And I've really fallen into what I'd call the value investing school of thought. Think Warren Buffett, Benjamin Graham, the intelligent investor, that sort of approach to investing where you try to value a company and then get it at a discount to that actual value and make measured growth projections in the future to figure out what the discounted value to that company is today. And that's how you determine what a good price to pay for it would be. And this is very similar to something like buying a real estate deal. I am a real estate investor at heart, so I have that same sort of approach when I go into stocks now, which I didn't really have before because I was just kind of buying the index. And don't get me wrong, I still do a little bit of passive index investing in my retirement accounts. But for me, I'm trying to maximize value while minimizing my downside. And that takes a lot of research and diligence and definitely a lot of discipline. But it seems like it is possible to do those things together if you play your cards right and you're investing for the long term, of course. In the short term, anything can happen and you never really know what's actually going to happen. And an example of that is this section of my portfolio right here. New World Order is what I called it. It used to be a collection of maybe 10 or so very large cap, mostly tech stocks, very high price to earning ratios, seemingly pretty overpriced. And I cut that down to these 4 holdings, and I might get rid of Alibaba at some point soon just because I don't really like some of the risks associated with Chinese investments in general. Not that there aren't good investments out there, but the investing environment with Chinese firms, at least from the US, it's very rocky to say the least. But I wanted to have some exposure to that market, and nonetheless, since China definitely has a good upward growth trend at the moment, and we'll see what happens. But anyways, I've narrowed it down to these 3 companies, and I could definitely argue that all 3 are overpriced, but not nearly as much as the other holdings that I trimmed off. These businesses are still have long runways ahead of them and lots of good things in the future, I would think. But this sort of investing might be a huge portion of most people's portfolios that you'll find on YouTube. It's really not for me. This is only a few percentage points of my portfolio. Yeah, 3.2% of this portfolio. I'm not doing a lot of tech stock speculation. You can see it definitely was a large part of my gains, really just by sheer luck and chance. I invested quite blindly at the beginning of 2020. I actually started this portfolio in February with very little money and started pouring more into it, especially into March and April, and tech obviously has had a huge run up in 2020 by chance, and it happened to work very well. I had some Tesla in there. I did think Tesla was actually decent value from a growth perspective long ago. Right now, I can't really say the same thing. You can make your own conclusion, of course, since it definitely depends on your risk tolerance, but that's what I'm kind of getting at when I'm talking about value investing. I'm not doing too many of those speculative tech, super high growth, very uncertain future stocks, going for more what I'd call sure bets. Nothing's actually for certain when you're investing in anything. You never know what's actually going to happen. But I'm trying to find companies that have a little bit more of a track record, definitely are profitable, bringing in cash flow, because cash flow is the lifeblood of any business. But even with that approach, my portfolio is definitely not protected from all market pullbacks. Since it's in the stock market, you're going to have market risk. You can't really shake it. And I got hit decently hard, not too hard, not nearly as hard as some people in that recent tech pullback that we had. And really the only lasting damage seems to have been here with my Chamath polyhypatia SPACs, which I bought really as a substitute to cash, thinking that they wouldn't go down very much, and sure enough they did. They were definitely well over their asset value when I actually bought them, but I thought that wasn't a big deal. Sure enough, I got stung a little bit here for a pretty sizable loss. I'm going to keep holding just because these are two investment vehicles that have not actually picked a target, since a SPAC is a cash vehicle that is used almost like a fund to then buy a company to take it public. So it's looking for a private company. And what seems to happen with a lot of SPACs, at least some of the high-flying ones, is they'll identify a target, shoot up, and then that would be a good chance to exit if you didn't want to actually stay in that company long term, which is kind of what I was counting on. Thought it'd be better than leaving some cash lying around. Sure enough, I got stung for now down about 20%. I'll keep holding for a while since they still haven't picked targets, and maybe I'll get back up to zero. We'll see what happens there. But I also saw a significant pullback here in Turtle Beach, which is one of my newer holdings, definitely one of my favorites now that I currently have in the portfolio. And I initially put in about $3,000 into it. Turtle Beach is a gaming accessory company that mainly focuses on console headphones, and they actually dominate something like 50% of that space. That's kind of its niche, but it's trying to build out different niches, which I'll get to in a second, since they recently had their earnings call, and it was actually pretty epic. But despite the epic earnings, they had a significant drop in their stock price. Let's go to that over here. You can see that with the rest of that tech plunge, here was lumped into that. Here being the ticker symbols HEAR. It was kind of lumped into that tech fall off and lost something like 30% of its value very quickly, just like a lot of the rest of tech, which I was very surprised by, since they're throwing off cash, have no debt. So I used it as an opportunity to buy another $1,000 or so of Turtle Beach, which added to my cost basis of now being at $4,000. So thankfully it's recovered a good bit. So has the rest of tech. It plunged, I think, a little bit more than the broader NASDAQ, and then has recovered more than the broader NASDAQ as well. So that's what you're going to get when you're investing in single companies. Typically, you're going to have a little more volatility than the whole market, which has a little bit more diversification built in. And like I said, Turtle Beach recently had their earnings call on March 4th. I did do a preliminary update before that, since they released their preliminary earnings from 2020, kind of summarizing the year there. So it should have taken some steam out of the earnings call. Yet despite that, and despite really overwhelmingly positive news at the earnings call, and nothing surprising, we still saw that big sell-off on earnings call day as part of the broader tech sell-off, which I still found surprising, but I used it as a chance to buy in. And that's a strategy I really like with value investing. When you have a value assigned to a company, when you have a price target in mind, that way when the stock actually falls below that stock price, you can be confident in making another investment on it. It's not just blindly buying the dip, but you have a target in mind, and it now looks like you're getting a better deal on the stock, since you think the intrinsic value of that stock is higher than it currently is. So it made the decision to put another $1,000 into here that much easier, since I had a stock target in mind, and it was well above the $22 or so, which is when I bought in that extra $1,000. I started buying here right around $20 a couple months ago, and now it's back nearing 30 again. It did get up over 30 before the earnings call. It was really surging in January on a lot of the good news with gaming and console sales and everything, which they directly benefited from. So anyways, let's get to this earnings call. And we can look at cash flow, which is one of the most important metrics that I think anyone should look at for any company. It's not the only one you should look at, since a company with low cash flow might simply be reinvesting it into different projects and into expanding its business, which is certainly valuable. What you really want to avoid is super high negative cash flow, since that can't go on forever. After all, you need to be able to have some sort of liquidity, and if you have negative cash flow, that is a problem. But anyways, you can see their cash flow from operations was about $20 million in the fourth quarter. This is a $400 million market cap company or so. It fluctuates around there right now. So pretty nice cash flow for just one quarter. And they had their best year by far, the highest level of cash flow from operations we've ever had, and was 21% higher than our prior record, which was $42 million in 2018. And that's compared to the $51 million they pulled in 2020 cash flow from operations. So really high cash flow metrics, and they have no debt. They paid off all their debt, which is fantastic, since that eliminates a lot of downside risk. they're not going to go belly up, or at least very easily, since they don't have a bunch of debt to worry about. They can really focus on expanding operations, and that's what they want to do really badly. Turtle Beach wants to expand into other areas in the gaming accessory market, not just console headsets, which apparently they have about a 50% market share of, maybe closer to 40% sometimes, and no one else is really close for console headsets. Consoles being like the PlayStation 4 or the PlayStation 5 now, and the Xbox. So those are a core part of Turtle Beach's business, and when those sales are good, that typically means that Turtle Beach's console headset sales will be good, and that is sort of the spine of its business. Now, it knows that it just had a surge in console sales in 2020. This probably won't last, or at least the sector should not have those same sorts of numbers every single year, at least for quite some time, since this was an unusual surge, not only from the pandemic, which they've noted that they've benefited from the increase in the number of gamers and the increase from console sales as well. That has created new gamers that need new gear, and then they can get these one-time sales and hopefully get some lifelong clients as well, or customers. I say clients since I'm about to be an attorney, and that's always the word I use for customers. But customers are going to be buying more gaming gear in the future. That's the goal. So I'd say if you're bullish on gaming, Turtle Beach is definitely a good company to at least look at. But recently, Turtle Beach has actually made some acquisitions to diversify their business a little bit, still within the gaming accessory sector, but they bought Rocat here, which is mostly like keyboards, mice, and then also other headphone products as well. Different types of gaming products, not just headphones. They're trying to diversify a little bit. That's not all they bought. They also bought Neat Microphones, which is not quite really gaming related, but maybe into that podcast industry, into people who are staying at home and need better microphones. This is a great sector to diversify into. It's these sort of bordering sectors to gaming console headphones. You have other parts that they could easily diversify into, other types of products, and that's exactly what they're doing. And I think that's a great decision from a business perspective when you're looking at the long-term health of the company. Sure, they can rely and rest on their laurels and say that we're good with having a 50% market share in console headphones. That's great, but they are looking for different markets to get into that are within their sort of core competency of accessories. They're not getting too extreme. Someone on the earnings call asked about getting into software as a service type models somewhere, and they said they were thinking about it, but they didn't give any specifics. I don't know if that's the best approach for here at the moment. They probably want to go for this sort of thing, finding new companies to merge with, new companies to acquire, and new product lines to open up that are within that sort of realm of PC accessories, since they have a good brand going, and I think they're looking towards the gaming industry in the future as being a much bigger thing than it currently is, and it already is on a nice upward arc. But here is a red flag, another thing to look for when you're analyzing companies. What is inside ownership doing? And we had an interesting development in February while Turtle Beach was on a huge rise in its stock price. The CEO actually sold off about $4 million of shares. That's certainly no small amount. And he did it in a couple of waves, if you want to call it that, throughout February mainly. I think he sold some in January as well. So he was sort of dollar cost averaging his way out a little bit, which wasn't asked about on the earnings report. I kind of hoped it would have been. But he sold about $4 million worth of stock. Is that a red flag? I'd say yes. I don't know what's going on with Mr. Stark here and what he's trying to do and why he sold off. I'm not too sure what his reasonings are. He can do whatever he wants with his money, but he still is the CEO, and he ended up selling at the recent top, really. So he got kind of lucky there, I guess, from that perspective, in that he sold at about $34 a share, and it's all the way back down to like 27 or something like that right now. So that's something to keep an eye on. I don't really have a lot more information about why this happened, why he sold off some of his shares. You didn't see a lot of other inside sell-offs, at least I don't think, that I heard about. But like I said, this is something you want to keep an eye on when you're investing in specific companies. What is inside ownership doing? What's their stake in the business? Are they trying to dip out for whatever reason? Keep an eye on that, since that could be a sign of other things to come. For all I know, he just wants to take some risk off the table. $3.8 million is a lot of money. You could be set for life on that, so maybe that's what he's doing. Not too sure there. But it's definitely a weird move, because Stark himself said in the earnings call that their near-term goal is to create another $100 million business in the PC accessories market. And right now, again, the company itself is worth about $400 million. So you'd be adding a significant portion of the business there in the nearer-term future. I think he said in the next couple of years. So it's a little weird that he'd be selling off stock right now if he's so rosy about the future. So again, just a red flag. I'm going to point it out here. I don't know what it means for the long term. It'll be hard to say right now, but as time goes forward, definitely definitely be keeping an eye on it. But otherwise, not a whole lot has changed with the portfolio. I can go over here to metals since I added a little bit to my gold slices since there was quite a bit of a pullback over the last couple months in gold, so I went ahead and put some money there rather than leave it in cash, since the government just keeps printing more money to pay for more programs and making the currency worth less and less. I want to be hedged into something that can protect itself from inflation while I look for other investing opportunities, since cash right now, I just don't like having a ton of cash. I do like having some liquidity and having options, so that's why I don't want to put it into high risk things. I don't see gold generally as a high risk thing. It shouldn't go to zero, I would think. We'll see. So I can at least have the option there as a sort of secondary form of cash. If I wanted to sell off this $2,000 in the gold trust, I could. If I wanted to sell off the gold miner stocks, which are much more speculative than just straight up gold, that's another option. So that's kind of my thinking there. There's quite a bit of a pullback there, so I wanted to have some more exposure while the prices were lower than when I was buying mainly over the summer. But that's all I pretty much wanted to go over today. You can see over the last month or so, there was a significant pullback, but my portfolio has regained a lot of that, still down about $2,000 over the last month, which is no fun, but that's going to happen in the short term. Lots of things happen in the market that don't really have much of an explanation. We had that random tech pullback. Granted, tech is very expensive across the board right now, so I can't really blame some people for selling out, but it just happens at seemingly random times. But you can see over the last week recovered about half of the loss from the last month. So we'll see what happens over the long term. I'm not investing for the short term. I'm investing for the long term, trying to maximize my wealth by letting it compound with time. But like I said, that's all I got for today. If you like this sort of content about investing and personal finance and want to see more of it, then definitely subscribe, since I'd very much appreciate that, and it would help the channel out a lot, as would liking this video so that more people like yourself can see it on this great platform of YouTube. And as I said at the beginning of this video, if you want to check out M1 Finance, go ahead and check out the description below. I have an affiliate link there. If you open up an account and actually fund it with some portion of money, I forget how much it is exactly, I might get a small commission, which would be great, and I'd appreciate that, and hopefully you get a good brokerage out of it as well. I do have a playlist on my channel. I'll go ahead and include that below as well if you want to learn more about some of the features and mechanics of M1 Finance, since I do think it is a nice little platform. But until next time, take care.